Okay, so the short side is far more interesting. As you probably guessed from my comments, I'm
Yes.
pretty worried about the market, and obviously I'm a credit guy, so look, it's not hard finding good shorts now. It's hard finding good shorts that actually work. But yeah, so the short side, there's a lot going on. So I think let's talk about NIO. So NIO is, first of all, let me lay the groundwork. So NIO is an electric vehicle manufacturer in China. They're listed on the New York Stock Exchange. That is, the ADR is listed on the New York Stock Exchange. So typical Chinese listing structure. The ADR is listed, but you actually only own a piece of paper that's an ownership interest in a Cayman Islands holding company. You don't actually own shares in the onshore operating company. So this company listed last year in the third quarter at $6.30 a share, something like that, around a $6.5 billion valuation. This company, I have to say, is the most egregious example of corporate capital misallocation I have ever seen. Right, so this company is essentially a VC project that's masquerading as a listed company. When they went public, they'd already accumulated $4 billion of losses. They'd only been around for 3+ years. They'd essentially lost $1 billion in each of the first 3 years. Look, some of that was due to the marking of the pref shares pre-IPO at a lower value, but essentially they still burnt $2.5 billion of cash in 3 years before IPO. To put that in context, Tesla, in its first 3 or 4 years of operation, it burned a couple $100 million. So essentially it burnt 10 times the amount that Tesla burnt in its first 3-4 years, which is pretty incredible. So what did they burn it on? So this company was founded by a guy called Bin Li, a Chinese internet entrepreneur, who has another listed vehicle called BitAuto. The ticker is BITA. It's an it's an auto e-commerce business where they do auto loans, auto-related e-commerce platform type business. So the guy has no experience manufacturing cars. So when he decided he wanted to build an EV brand, the first thing he did is he opened his wallet, or he opened the wallet of his backers. And essentially he went around the world hiring engineers. So this company, despite the fact that it's never sold a car, never will sell a car outside of China, they have R&D research offices in Munich, in Oxford, in London, in Silicon Valley. They went on a hiring spree like you wouldn't believe. At the same time as you're hiring a lot of foreign experts, he tried to build a brand in China. And the way he tried to do it was by opening a number of, I don't want to call them stores because that's not doing them justice. They're called NIO houses, houses with a capital H. They're a combination of like a store and a health club and a library and a daycare center. You know, these things are essentially places you'd go to hang out with your family and also learn about NIO cars, I suppose. But essentially massive cash suck, fixed cost investments. So he opened about 20 of these things, 10 to 15 of these, more than 15 of these things around China. And he got the engineers to start developing some cars. And right now they have 2 models of car electric vehicle. One's called the ES8, which is the first model, which is a 7-seater SUV. Not really practical in China when you think about the one-child policy, but anyway. And then the second one is called the ES6, and that was released about 6 months ago. So look, we didn't really talk about my methodology for shorting too much, but it's important to know I look for 3 things. One is a sustainably bad business, right? So it can't just be levered. It has to be a business that just doesn't kind of make sense. So here's where NIO really checks the box, right? So if you think about a typical auto OEM, generally speaking, they have extremely high fixed costs because they got to build the factory. And, you know, if you sell 5,000 cars, you lose a lot of money. But if you sell, 100,000 cars, you make a lot of money because, the factory's been built. You have the tooling, you have the same number of employees or roughly the same number of employees, whatever, right? So huge fixed cost, huge operating leverage. The problem with NIO is they never owned their own factory. They outsourced all the manufacturing to another OEM called GAC, JAC, which is kind of like a second or third tier OEM in China. Not only did they outsource manufacturing, they committed to cover the operating losses of that outsourced factory for the first 3 years of production for both of their first 2 models, right? So, if Jack builds a factory for them or builds the production line for 100,000 cars and they're only selling, say, 20,000 cars a year of a given type, they have to make it up to Jack. In terms of the differential for the first 3 years, right? So, and even if they do sell a much higher number of cars, they're paying a fixed fee per vehicle for the production, right? So if you think about it, in a very competitive market, which obviously the Chinese EV market is the world's most competitive EV market, because there's over 200 EV companies in China, and even in NIO's niche, which is the higher end luxury segment, there's probably 20, 25 competitors. If you cut prices, for example, the average price of one of their vehicles is 450,000 renminbi, but they give incentives, whatever, they cut price, they're still paying the same fixed fee per vehicle to GAC. So you have a lot of the negatives through the fixed cost and the loss reimbursement, but you also don't have the positives. You don't really have the operating leverage. Which is a huge problem when you're kind of a startup auto that really needs to scale quickly and you're burning a lot of cash from the outset, which obviously they were doing. So that kind of attracted me to the business initially, because I realized the model was really not set up like a normal auto OEM, and just the cash needs of the business combined with this structural inefficiency meant that they would run into trouble pretty quickly. So that was, they listed at the back end of, third quarter last year. Then all of a sudden the warning signs kind of came thick and fast, right? So they only had one foreign board member, a Silicon Valley veteran called Pads Marie Warrior. She quit a month after the IPO, dumped all her stock. Then the company did a convertible bond deal, basically 4 months after the IPO, because they were burning 500 million cash a quarter. They raised 750 million cash. Basically, they timed it very well. The stock was very high. The strike on the convert was, $8-9 or something. Maybe higher, actually. I need to look it up. But they did the convert, but that was a problem because now all of a sudden they have debt at the holding company. So now we're in business, right? So on my metric, bad business, lots of debt. So all of a sudden they have $750 million of debt, which, if I have a bearish view on the stock, that's going to stay debt. It's not going to turn into stock. So then the problems started coming thick and fast. So obviously the overall auto market in China slowed down. The government cut subsidies aggressively, right? So you were getting subsidies to buy electric vehicles in China. Those were essentially cut in half in June. So volumes collapsed. Then they had a battery fire issue. So they don't actually make their own batteries. A Chinese company called CATL, C-A-T-L, a big Chinese battery company, makes their batteries. But they had a similar issue to Tesla in that the batteries started spontaneously exploding. So that kind of happened mid-year. They had to recall all the batteries. They had to recall about a quarter of their cars that they'd sold. Obviously, it was a huge reputational issue and also a huge cost issue. So sales volume started to go down pretty quickly, and that was from low levels, right? So they were selling, call it 2,000-3,000 cars a month in November, December last year, and by summer this year they were selling 1,000 cars a month. So it kind of looked like they were getting close to the wall. The reason I say that is you had these issues, that executive departures, the massive cash burn, the recall issue. Then you started seeing kind of what I call going dark from the company. So going dark is kind of a catch-all term for when a company just stops reporting financial requirements. So the company started exhibiting this interesting pattern where they would report positive news. So let's say a given month's deliveries were better than expected. They'd report it, but then they wouldn't report earnings. So the second quarter earnings.
That's interesting.
Second quarter earnings for the June quarter normally. So going back, the third or fourth quarter last year, those earnings were reported, relatively promptly, call it 40, 45 days after the quarter. They didn't report second quarter earnings until September the 24th, right? So almost the end of the third quarter is when they reported second quarter earnings. And it's pretty clear why. They didn't want to report the horrible numbers in the context of a financing raise, right? So going back to May, they had been putting out press releases saying that they were trying to raise capital from a Beijing local government affiliate called E-Town Beijing, which is essentially like a quasi-governmental entity that is designed to support investment in the Beijing area. So they put out a press release saying they're negotiating to get 10 billion yuan, which is, $1.3 billion from this entity. But then, 5 months later, they provide no update. All right, so by this stage, fast forward to, September of this year, I kind of think they're they're out of cash. So they have the 750 million of debt that they raised from converts. They've burnt through all that. They also have, a few hundred million of Chinese bank debt. They're running negative working capital because they're essentially not paying their suppliers. And they're also building a bit of inventory on their balance sheet, but they're essentially still funding themselves through their suppliers, and they're burning $500 million of cash a quarter. So fast forward to September, and they make an announcement on September the 5th. Don't worry, we're raising $200 million of a new convert, $100 million from the founder, Mr. Lee, and $100 million from Tencent. So Tencent was a strategic backer pre-IPO. They also bought part of the first convert, the one that they issued in March, which, by the way, is now trading at 40 cents on the dollar, right? So it's gone from par to 40 cents on the dollar in 6 months. So not exactly a great sign. So they announced that they're going to raise $200 million, which, look, they're burning $400-500 a quarter, so that's not a lot, but that might buy them a month and a half, let's say. So emergency liquidity to get them to some kind of other financing solution. They announced that on September the 5th. They don't say anything on the call on September 24th on the earnings release. They specifically refuse to comment on the financing situation. They just say cryptically that there are ongoing discussions and it has not been easy to find a solution that benefits everyone. That's a direct quote from the ex-CFO. Then we don't hear anything else for another month. Then the CFO, the guy who made those comments on the call, quit. Then the number 2 finance guy, also the only other finance guy to speak on the call, quit. And fast forward to early December, and almost on a daily or otherwise daily basis, there are reports in the Chinese press that the company is either out of liquidity or potentially exploring restructuring solutions or in a cash crisis, or that lawyers have been called in to discuss potential bankruptcies. The Chinese press is essentially reporting on this with regularity, but nothing is appearing in the Western press. The only thing that's appearing in the Western press is fluffy, bullish Twitter posts from Neo's Twitter feed saying the future's bright. We just signed a deal with Mobileye, or, deliveries were great in October. Nothing about the price of those deliveries or the incentives that they're running to generate those deliveries, or even if they're paying suppliers, just deliveries were good. So we're in this weird nether zone with this company where it's very strange. There's 2 audiences, right? There's the Western audience that trades the stock, which is largely retail and frankly uninformed and not sophisticated in my view, where the market cap is still $2.5 billion. Yet the bonds trade at 30 cents on the dollar, right? So if you just run through the implied enterprise value of the company looking at the bonds, the whole thing's worth $400-500 million. But if you run through the implied enterprise value looking at the stock, the whole thing's worth $4.5 billion, literally 10 times the value of that implied by the bonds. So look, I wrote this anomaly up on my blog. It's pretty straightforward for credit guys like myself. Like normally when bonds trade at 30 cents on the dollar, the equity portion of the enterprise value should be de minimis, right? So I'll give you another example of a situation.
Has a company ever contacted you when you did a blog post about something like this?
No, I've tried to contact the company. I've contacted the company directly a number of times to ask for comment, and essentially they've gone dark. If you ask them a question about the status of their financing, they simply say no comment, please refer to our public filings, and we'll update the market when necessary.
Got it.
But that's the point. The public filings are late and or missing, right? They haven't given an update to the market on either financing transaction, either the Beijing E-Town transaction or the convert transaction. In fact, if you call Tencent and ask them, did you close your convert in investment in Neo? They say no comment, which is strange because you'd think Tencent would be supporting the company, given that they bought the last bond deal and theoretically remain shareholders. But look, I think they've closed no financing. I think if they had closed financing, they'd trumpet it to the world, right? Given that they appear to be running on fumes. So the real anomaly is in the stock because the credit market gets it. And again, that speaks to the heart of my approach, right? That you have these anomalies in smallish stocks and or corners of the market where, let's be honest, the other side of the trade is probably not that sophisticated. It's not used to looking at like credit versus equity arbitrage, or is not doing the deep dive credit work that maybe the hedge fund guys who own the bonds have done, right? Otherwise the bonds wouldn't trade at 30 cents. So look, you can set up a great trade, I think, where you buy the bonds at 30 cents and you short some delta, you short the stock. Because look, if the company survives, those bonds have to be worth par, right? They have to go to par. In fact, if the company is recapitalized and more than half of the assets transfer ownership, then those bonds have to go to par immediately. In other words, there's a change of control put on the bonds, right? So if you really thought the company was going to survive, those bonds would go from 30 cents to 100 overnight, assuming they got recapitalized, right? Because given where the stock price is, it would have to be more than half the company sold at a good valuation to save the company. So obviously the market is telling you that's not going to happen. Otherwise the bonds wouldn't be at 30 cents, right? But then why is the stock market telling you the company is still worth, $4.5 billion enterprise value? That's the real anomaly. So look, it's one for the books. And the reason I say that is because it kind of hits on a lot of these angles. It hits on the credit versus equity angle. It hits on the kind of Chinese company abusing U.S. capital markets angle by going dark, not providing necessary disclosures. In fact, it hits the general nail on the head with regard to foreign private issuers. So I'm not sure if you know, but there's a whole category of companies that even though they list on the New York Stock Exchange, their ADR, they're not subject to the same disclosure requirements as a local listing, as a normal US company, right? So Microsoft or whatever, or Johnson & Johnson, they list on the New York Stock Exchange. They have to file quarterly reports, quarterly cash flow statements within a certain period of time. They have to file 8K notifications anytime something material happens, whatever. For foreign private issuers, not only do they only have to file twice a year, they don't have to file 8Ks, they have to file 6Ks. But they only have to file those current reports if something deemed material in their local jurisdiction happens, right? So let's say they're a Chinese company, and let's say they get some very dilutive, terribly toxic financing from a Chinese bank. But let's say in China that getting financing from a Chinese bank is not required to be disclosed to stockholders. By the letter of the law, they don't probably have to disclose that in the US. Which is kind of crazy, right? Because they're listed on the New York Stock Exchange.
Yeah.
So, it hits all these various angles. Obviously, it ties in with the whole hype around EV. And I wrote a first blog post on it back in March saying NIO is going to end in tears. That was when the stock was, $5.50 or whatever, and now it's $2.30 or something. But even at $2.30, it's a $2.5 billion market cap. Right? When, as I said, the bond's telling you the equity is 9 times underwater. So, look, I still think it ends in tears. They've kind of lasted a few months longer than I thought, but I think it's a very high conviction short into the first half of 2020.